Hi, my name's Laura Chipp and I'm a director at VatNav. We decided that we were going to start doing a lot more videos about relevant VAT topics for our clients and for others. And today's video is all about partial exemption. So we're going to be talking a little bit about what partial exemption is, when it may apply, and how maybe you can help get the process a bit more efficient. So what actually is partial exemption? Now, it's all to do with the recoverability of input VAT. Now, one of the main rules in VAT with input VAT is that it's only recoverable when it relates to a taxable service or a taxable supply. So, if a business only sells taxable things, or things which would be taxable if they were in the UK, then they can normally recover all their input VAT. If a business only sells exempt supplies or non-business supplies, so it's sort of, it's not taking any business income at all, then there's no recoverability of input VAT. But where we're looking at partial exemption, it's normally when a business sells both taxable and exempt or non-business stuff. Now, the main rule in terms of input VAT allocation is that regardless of how the business is structured, how many sort of taxable or exempt sales you make, if input VAT incurred on a purchase relates only to something that's taxable, it's fully recoverable. If the input VAT relates only to exempt or non-business supplies, you can't recover any of it. But in businesses that sell both taxable and exempt sales, there'll be a lot of input VAT, so overheads or just things that can't be allocated to a particular sector of services, which becomes residual. And then the recovery is apportioned for VAT under a partial exemption method. So where we have a business that supplies both taxable and exempt goods and services and or has some non-business income, these businesses are partly exempt and need to think about the allocation and recoverability of their input VAT in a lot more detail than businesses who are either fully taxable or fully exempt. Now, we do a lot of work in the travel and property industries, and you may think we don't come across partial exemption very much, but actually there are many examples, and here are some examples of businesses that we've come across quite recently and we come across quite often. So the first one, we do a lot of work with property businesses. Some property businesses may sell long-term residential accommodation, which is normally exempt. And they may also sell short-term accommodation, which is normally standard rated. So in one business, we have taxable short-term accommodation and exempt AST income. The same goes for travel businesses, which may supply holidays, but also holiday insurance. Here, the holidays are normally taxable or would be taxable if in the UK, whereas insurance would normally be exempt. We also have a couple of businesses we deal with who provide educational supplies, some being school tutoring on a commercial basis being taxable, and EFL, which can be exempt in many circumstances. And then we've also put a couple of other examples, so charities, where we sell goods which are taxable and we receive non-business donations. A landowner renting out land-only services is exempt, and wedding facilities standard rated. And also one that is not considered very often but can apply is if you just run your own office and you sort of treat that as an overhead of your own business, great. But then you may let out meeting rooms within your office and not opt tax. And in that case, the meeting room hire can become exempt. So you still have a business which is partly exempt. Now, how does partial exemption actually work? So in a business in one period, we'll have three pots of input VAT. First one is input VAT directly relating wholly to taxable supplies. So an example of this that we see quite commonly is for property businesses which have AST income and short-term tourist income. They often get a lot of commission from online travel agents, which relate only to the short-term accommodation. So any VAT incurred on commissions from those online travel agents would in those circumstances be fully recoverable. Input VAT directly relating wholly to exempt or non-business supplies. So, for example, let's say a school business which provides school tutor taxable tutoring services and exempt EFL services. Any materials it buys that just relate to the EFL services would be wholly exempt from recovery. And then everything else. So the third pot is the mixed use of input VAT, which is basically anything. So it would normally be your overhead office costs for the business and other sort of overhead services, so your professional fees, accounting, etc. But it could also include anything. Let's say you have a sort of larger invoice, which includes three items that are for taxable use and 20 items that are for exempt use. If there's no sort of split out in that selling price, it's just one invoice from one supplier. That's still, though we can pinpoint what services it relates to, because it relates to a great number of services all for one selling price, it's still residual and in that sort of mixed use pot. So the first thing is that it's really important for partial exemption that we can distinguish between those three pots. So coding within the accounting system is really important here. Um, and partial exemption, annoyingly, the year end for partial exemption does not normally coincide with people's accounting year. It just really is, it's either it's March, April, or May, depending on what VAT return quarter dates you have. So if you're on calendar quarters, which end March, June, September, and December, your partial exemption year will go from 1 April to 31st of March. Doesn't matter if your financial year end is something completely different, that will just be your year end. So everything that you, every sort of input of that you incur within that particular year becomes within that partial exemption year and has to be assessed both within the year and at year end when you do your partial exemption annual adjustment. So what we normally do with partial exemption is we work out the proportion of input VAT on a quarterly basis based on the turnover values normally within that quarter. And then at year end, for anti-avoidance purposes, we do an annual adjustment, different to the normal types of annual adjustments we normally talk about. But then the quarter following the partial exemption year end, there will be an annual adjustment to be done. So if your partial exemption year runs 1st of April to 31st of March, you would have your partial exemption annual adjustment to do on the June VAT return. Now, most businesses within who are partly exempt will be using the standard method, mainly because the special methods are becoming increasingly difficult to agree with HMRC, but often because normally this reflects a fairly reasonable use of the input VAT. So this is also the default calculation, and you have to use this unless you have agreed a particular special method with HMRC. So once we've got our three pots in place, we have our taxable pot, input VAT only relating to taxable stuff. We have our exempt pot, input VAT only relating to exempt stuff. Once we've got those two organised, we can kind of almost forget about them. We know that we're just recovering all VAT for the taxable sales, and we're recovering no VAT relating to exempt sales. And now we're focusing on our mixed use pot, so our sort of overheads essentially. And what this is we total up our overhead input VAT firstly for the quarter, and then later for the year as a whole. And whatever it is, we multiply it by the proportion of our total turnover that is taxable. So let's say we had taxable turnover of 60k, total turnover of 100k. We know that we've got 60% of our turnover is taxable, so we can recover 60% of our overhead input VAT. So for example, let's say for turnover purposes, we're looking at a property business and we've got 200 grand of residential lettings with 100 grand of serviced accommodation lets to tourists. And for avoidance of doubt, this is not Tom's related serviced accommodation. This is a whole host of other videos at the moment. Anyway, but for the purposes of this, let's pretend that none of this falls under Tom's. So 100 grand of normal standard rated short-term accommodation and 20 grand of management agency services. So this gives us total turnover of 320. So then we say, well, we've got our three pots of input VAT then further down the page. Input VAT wholly relating to taxable stuff. So this is probably our OTA commissions here. We've got 12 grand. Wholly relating to exempt services. This could be, I don't know, like letting agents fees just for the ASTs, say, 14 grand. And then our mixed use overhead input VAT of 10,000. So what is our partial exemption percentage? So firstly, we know that out of the 320,000 turnover, we have 120, which is taxable, being the serviced accommodation and our management fee income. So our percentage of taxable sales is 38%, just being the 120 over 320. So in terms of input VAT recovery in the quarter, we have 12,000, which relates wholly to taxable services and which is 100% recoverable. And out of our 10 grand, which is our mixed use input VAT, 38% of that can be recovered because that's our partial exemption percentage this quarter, which is 3,800. And this gives us 15,800 of VAT recovery in this particular quarter. Partial exemption special methods. I think I've heard recently that this is becoming increasingly difficult to agree with HMRC, and they're taking a long time, becoming more complex. But businesses can opt to kind of propose to HMRC another method of calculating their percentage of recoverable input VAT. And it could be based on anything that's reasonable for your business. So, for example, it could be looking at headcount. So, let's say we know that out of the business, 5 members out of 20 staff only focus on the exempt side. We might say that, we'd say it's 15 out of 20 staff are focusing only on taxable stuff, so we've got 75% recoverable. Floor space, maybe that, let's say we've got a shop and we can sort of pinpoint the exact amount of stuff. Let's say it's a charity, we've got, 8/10 of the shop is relating to goods that are donated versus 2/10 which are sort of bought and sold. Actually, that's not a very good example, but let's say anyway that there's a shop of sorts that sells some taxable stuff, some exempt stuff, and we can look at the area, the floor space as a marker. Transaction count, again, we could say, especially we see this in the financial industry quite a bit. We're looking at various transactions, how many are exempt versus taxable. Overhead costs, time costs, it could be anything you want. There's no particular list of options, but the key is that you have to agree it with HMRC before you actually put it together. So this has to have prior agreement with HMRC, and we understand this is getting a lot more complex and restrictive. In any case, whatever method is used, the partial exemption annual adjustment is required after the end of the financial, at the end of the partial exemption year, to make sure that businesses don't recover VAT disproportionately over a single year. So, for example, you could have a business who says, right, we're just going to put all our overhead input VAT down in the month of June. And then let's say in our quarter, April to June, we just decide to make only taxable sales, and then we would recover all of our overhead input VAT because the partial exemption percentage for that 3-month period would be 100%. So you could basically say, right, let's do all our management charges, all our commissions in that one quarter and get 100% recoverability. Great. I mean, no, that's not great, because what happens then is HMRC say, well, you have to level it out over the year as a whole. So although we do these quarterly kind of provisional calculations in looking at what amount of VAT, what amount of taxable stuff we were doing in each individual quarter, we have to then level it out after year end to make sure that we're not disproportionately recovering a load of VAT in periods where we've got a higher amount of taxable sales. So then we basically look at what amount of VAT we've recovered in each individual quarter. And then we look at our taxable over total sales for the full year and we compare the two. So as an example, and this looks a little bit more convoluted, and it is. This is basically the format that we do our partial exemption annual adjustments in. So let's say that in each of the quarters, so this is just a calendar quarter partial exemption again. And let's say in the period, the quarter to June, we have taxable input of VAT of 10,000, exempt input of VAT 5,000, residual overhead of 20,000. And in that particular quarter, our turnover on the right-hand side, we had 600,000 of taxable turnover out of a total of 1.2 million. So our taxable turnover was 50% of total turnover. So in the June period, it follows that we would have recovered 20,000, being our full 10 grand relating solely to taxable stuff, and 50% of our residual 20,000 VAT. And this is the case for all the quarters. It follows that we would have recovered 140,476.19 based on all those figures individually. We have a total amount of input of VAT incurred in total of 208,000. And we basically then say, right, well, out of the entire year's taxable over total, what percentage does that give us? So we do the 2.7 million over the 4.8 million turnover. This gives us a recovery rate of 57%. And so we basically say, out of our residual income of 120,000, we should have recovered 57% of that input VAT. And this gives us, let's go back a minute, it should have given us 68,400 of residual input VAT recovered over the year. Then if we add the 70,000 of input VAT only relating to taxable sales, which is always recoverable at 100% anyway, regardless of what happens over the year, we get total recoverable input VAT of 138,400. Now, in the year, let's go back, we know that we've claimed 140,476.19 based on the quarterly calculations that we've done. And we know that we should have recovered based on the annual amount as a whole. We should have recovered 138,400. So this means that we've essentially recovered £2,076.19 too much. So that is our partial exemption annual adjustment. Now, it doesn't always end up in a payment to HMRC. It could end up in a payment from HMRC. If you're a business where you think your recovery of input VAT versus your taxable turnover percentage might vary every quarter, it's a good idea to potentially keep an eye on the sort of overall yearly calculations to make sure that you're not recovering too much in any one quarter, because no one likes a nasty surprise at the end of a partial exemption year. The other things we do as part of this is check as to whether a business is under the de minimis limits, which are the three checks at the bottom here. So if your overall exempt input VAT is less than 625 per month on average and less than 50% of total input VAT, so basically here we've got a really small amount of exempt input VAT that we're incurring, HMRC just say, okay, fine, you can just recover it in full. But the checks that we do, and these are sort of programmed into our spreadsheet, basically formulate whether that's the case as part of the overall annual adjustment. And the answer here is that the business is still partly exempt, and so there's no full recovery there. The de minimis limits here they're all obviously quite small, and I think it's just so I think sometimes we have a lot of travel businesses who just do small amounts of travel insurance and earn insurance commissions which are exempt from these services. They're often under the de minimis limits because the insurance commission and therefore the related exempt input of that is so low. But it's always best to check before you restrict your input VAT. But normally, with a de minimis limit, it's basically when you're pretty much like hardly any of your sales are exempt, and you have very little related input VAT as well. So I think if you're kind of near those limits, then it's a good idea to check. But I don't think this is going to happen. If you're looking at sort of, over 90% or less taxable sales, then it's potentially unlikely for sort of any businesses unless you're at the very lower end of the registration threshold. A quick word on the capital goods scheme as well. Um, Basically, with larger items, and this is normally, we're just looking really at property here. When you buy capital items such as property or property itself or the refurbishment of capital refurbishment of property, and the expenditure is more than 250k. It's soon going to be increased, we understand, but at the moment the limit is 250k. When the purchase falls within the capital goods scheme, so again, we're looking at property or normally other sort of capital refurbishments, extensions to property. You now must apportion the input of that over a 10-year period rather than just that one partial exemption year. So, for example, let's say the commercial property is purchased for 500k plus VAT in 2024. The business intends to use it as an apart hotel. So it's at the moment it's intending to only use it for taxable services. And so it can legitimately cover all its input VAT in year one. So it's going to recover 100,000 in input VAT. But in 2026, the business decides instead to lease the building to another operator without opting to tax. So usually this would be an exempt supply, which means no input VAT recovery. So the 100k that has been recovered is essentially set out into 10 one-year blocks of 10k. So in 2024, the whole use was taxable, so that the 100% recovery there. 2025, again, everything's taxable, so that 10 grand is now safe for 2025. In 2026, we've now only got exempt supplies in 2026. So 2026's 10,000 now needs to be paid back to HMRC. Now, if 2027, the business is still doing the same thing, they have to pay back that proportion, that 10 grand to HMRC. 2028, similar. Every year for the 10-year period, normally after the purchase, you have to consider the taxable use within that year. And if the answer is always that it's exempt or there is a proportion of exempt use, there will be a clawback of that VAT to HMRC. The same would happen in reverse. Let's say you bought the commercial property in 2024 and recovered none of the VAT because you intended to use it as you leased it again without an option to tax, and so you recovered none of it. And then let's say you did the opposite and a couple of years later decided to use it as an apart hotel, then you would get that 10 grand of sort of extra recovery each year for the remainder of that 10-year period that you were using the property on a taxable basis. So the key thing, we have a lot of businesses who just decide to purchase property and don't consider the VAT treatment. You really need to think about this because 500k is perhaps quite a low amount compared to some of the properties that we see. And in a lot of cases, people haven't considered this clawback under the capital goods scheme. Actually, I was dealing with someone this morning in exactly the same situation who's just purchased a property and hasn't considered the fact that he's going to be using it for only exempt services. So we do need to think about this because these are really high value items normally. And sometimes with some planning, this could be alleviated. So I said that, if you're doing a commercial lease, it's often exempt. If you opt to tax that commercial lease, that potentially can make it taxable. So this problem is avoided. A lot of these problems for VAT are always best off looked at the forefront, and then we can sort of see if there are options available. It doesn't always work out that there are, but there are always things we can have a look at. But I think especially for the capital goods scheme, because we are looking at such high value items, it is really important to look at this at the point of the large purchase. So some final tips for partial exemption. So I think it makes it a lot easier if you categorise input VAT between the three pots that we talked about: taxable, wholly exempt, and residual when putting the stuff onto the system. This will make things a lot easier at quarter end and year end. You should consider the pots quite carefully. Sometimes I think people make mistakes quite understandably, but this sometimes leads to people putting stuff that actually is fully taxable down to residual, and sometimes vice versa. So want to ensure that businesses recover the correct amount of VAT, and certainly not too little or too much. But I think, yeah, either way, we want to be accurate. Yes, as I've said, consider the input tax position in advance for large capital purchases, to ensure that things are optimal. The partial exemption annual adjustment, please do get a clear template. Obviously we have one ourselves, that is sort of programmed quite nicely, but things do change, and sometimes we see people using a template from that's been given to them by someone, but they haven't realised that the formula is sort of wrong, or it's leading in from a hidden spreadsheet and stuff. So we do need to make sure that that position is looked at by someone who knows what they're doing. And partial exemption is an area that does sometimes get updated and changed. So please do ensure that you review your position regularly to make sure that you're within the scope of the VAT law, but also that you're getting the best position for yourself. So that's a very quick overview on partial exemption. There are a lot more intricacies and complications, but the main point of this was to help businesses who have never heard of this before, and also some of our own clients. We do partial exemption annual adjustments for once a year, and we always get asked, "What is this?" It's like, well, we've said this, have this conversation every single year. So now we've got this video, which hopefully will help things stick in people's minds a bit more. There's stuff to read on the screen, and I'm talking to you. So hopefully this will be helpful for people. If you would like to, obviously, if you'd like to talk about it with us, or if you'd like us to look at your partial exemption, then obviously please let us know. Our details are at the start of this slide pack and on our website. I would just add at the end, this is a very general run through. Please do take proper advice for your own business situation. A lot of things in VAT can be missed when people look only at the general position. It's really, really important to make sure you take advice for your specific circumstances first. Thank you very much.